Has this ever happened to you? You've taken a trade and then the market decides nope and goes the opposite direction. If so, this video will save you. Today, we are diving into reversal trading. This video will explore how to get the most out of reversal trading, how it works, and which indicators might be best suited for it. Imagine catching a crypto just before it pumps and does a 10x. That is the magic of reversal trading.
Wow.
Reversal trading involves buying low and selling high. Essentially, you're looking to catch the market at its turning points. The biggest and most obvious question is, how do I know where a turning point may be? This is where the magic of technical analysis comes into play. We have a wide array of tools at our disposal in order to deduce where these magical points lie in the market. To start, we have the famous RSI. RSI is a momentum indicator showing the struggle between the bulls and the bears in a market. It is one of the most commonly used trading indicators, but is also one of the most frequently misused and misunderstood. Markets are assumed to have a balance point, a point where the market and charts are deemed to be behaving and at a fair value. Just like a magnet pulls on metal, price is drawn back towards this fair zone. When RSI starts to enter an overbought zone or oversold zone, this can be deemed an imbalance, and the RSI needs to return to its area of balance, around 50. Just like a rocking horse, the further you swing in one direction, the harder you will swing back. Therefore, when RSI enters these extremes, we can assume that the market is going to swing back in the opposite direction, as this cannot be maintained. Therefore, using the RSI to look for overbought and oversold zones can be a great piece of confluence in deducing a reversal in the market. Let's go into some more complex indicators. We also have the famous Bollinger Bands. As previously mentioned, the market can be viewed as a rocking horse, but the middle and balance point of the market can be looked at as if it were a magnet that pulls price action towards it. When using Bollinger Bands, that midline is essentially the magnet. The further the price gets from this magnet, the harder it pulls. The upper and lower areas are zones where the magnet might pull the hardest or find support or resistance. Looking for when price reaches these outer zones can give a really great indication of when the price might reverse. For example, here we see price come down and touch the lower Bollinger Band. We now know the price is attracted towards a midline, and therefore we might see a strong bounce. Volume profiles are another popular tool to decipher reversals in a market. Chart Prime has released a free dynamic support and resistance zones indicator you can load by searching on TradingView and using this one by Chart Prime. There are various interpretations to these types of indicators. However, one of the simplest is identifying possible support or resistance levels in the market and confirming them. These are naturally going to be areas in the market where the price might reverse. Volume profiles show the amount of volume traded at each level in a market. Now, generally speaking, we would expect to see high amounts of buying or selling occurring at major market levels, thereby confirming their existence. Looking at your volume profile for large spikes can help confirm that this region of the market typically sees large trading activity and therefore might be likely to experience a reversal. Here we see price come down. However, our volume profile suggests there is a pocket which is a likely support level. Therefore, here we could predict that there might be some buyers interested at this level and a bounce is due. Using confluence between indicators can give you the highest probability of catching those bounces in the market. So load up those charts and give it a go. And don't forget to join Chart Prime's free Discord server for the best indicators to spot reversals in the market.